Today on Resource Talks, everyone's favorite Kiwi is going to be talking to me about what he's buying, what he's selling, and what's really going on with the world, and whether everything really is right with the world. Just briefly for people watching or listening, if you want a summary of this conversation and all the other interviews that we do on Resource Talks, go to resourcetalks.com. There's a free newsletter. It goes out once a week with a bullet point summary of all the conversations from the week before. And of course, Kiwi I'm talking about is Trader Ferg. Ferg, thank you so much for investing your time with me today.
Thank you for having me back on, Antonio. It's always a pleasure. I enjoy
Pleasure
this.
is mine. I think I called you an Aussie once, like 3 years ago or something, and I still cannot forget myself about it. So that's why I'm emphasizing the Kiwi part of it. It was already a pleasure, really, reading your most recent post called Portfolio Speedrun, and the subtitle there was Taking the Axe to a Few Positions. And you kick off the article really interestingly with Howard Marks quote. I think you do like Howard Marks a lot. You quote him a lot in the articles, but the second part of that quote is really interesting, where he says, quote, "We never know where we're going, but we sure as hell should know where we are," unquote. And that's probably like the whole podcast can be based really only on that thing. But where are we right now? What's going on with the markets these days?
Yeah, so I started with that quote because it's literally my whole process is trying to just observe like what are the things we can tune into that are actually going to give us an edge in the market. And a lot of this will ring a bell from my mentor Brad that I've often talked about. But one of the first things he taught me was John Templeton's maxim, which is bull markets are born in pessimism and grow in skepticism, mature in optimism, die in euphoria. And it's kind of like no one ever knows exactly where you are on those scales, but you should always kind of have a feel for where you are on it. And it's really an art, like understanding like, is something in maximum pessimism? And like I've tried in some of my writing to point out like the point of like real maximum pessimism. I think I wrote a piece recently called Rules of Thumb, and I tried to like pinpoint it with coal. And it was I believe it was in late 2020 or even early 21. And there was just nothing. You couldn't find a single person that even was interested in it, covered it. You were like shunned if you even mentioned it. The only ETF in the whole space delisted and literally dumped all the stocks. So anyone that was trying to play it literally got dropped off at the bottom because the vehicle literally unloaded and liquidated the equity. So you couldn't have even made money in a sector that was about to do really, really well. You had the likes of Peabody threaten after going bankrupt in 2016, literally threatened to go bankrupt a second time, and that put in the bottom. You had the vast majority of majors trying to get rid of it. Like they were all saying, we're going to get this off our balance sheet. We're going to spin it out, dump it. And sentiment was just absolutely in the toilet. I remember I mentioned it in an interview, and I started one of my coal pieces with it, where I just took the clip below the YouTube interview. And the first 4 comments, the first one was like, this is it. He mentioned coal. This is the equivalent of looting Jewish homes during the Holocaust. The second comment was like, this guy's got no moral compass. I'm never listening to another one of your interviews like for the host that was hosting me. And I can't remember the others. It was just people absolutely railing. And then obviously that was what I kind of determined as absolute peak pessimism. And if you can find areas with that, like this whole game is a game of expectations. You want the absolute lowest expectations you can possibly have. Often some of the best returns are when I've gone into a sector when I even struggled to come up with a bullish narrative. I was like, yeah, it's really, really bad. But I think in the future it might be like, it might not die. It might be like, okay, I've got a recent corner of the portfolio in seismic oil exploration. And to my surprise, it's actually one of my better performers. But when I went into it, I wrote the start of the thesis. I was like, you're going to have to go into this with a 5-year time frame and expect nothing from these positions. The oil thesis hasn't even started working. So to expect these companies to make money is, you're like super early. And surprisingly enough, some of those are actually, because the expectations is so low, it's actually surprisingly easy to make money in some ways. And then to take that to the other end of the spectrum, like what does euphoria look like? And I'd argue euphoria is when it's like the Robert McNeely, he gets overly quoted, but just the idea that the valuation is so great that there's no way they can ever grow into it. Just everything is priced to perfection. He literally goes through their valuation and is like, if you understand what this valuation means everything is priced to perfection. And I'd argue some of the likes in NVIDIA, if you start going out on how much they need to grow sales to justify that valuation, the numbers just get so big. It just it's hopelessly euphoric on the extrapolation of what it needs to earn to justify its valuation.
It's if you have to piss off people to be a good investor, I think that is a task I'm up for. It's something I've trained for my whole life. You always seem to have a game plan as to how to position or deal with these things, though. How do you do that right now? I mean, with everything that's going on, right? And it's you're not like a doom and gloom personality. It's actually why I keep asking you on. I'm tired really of the doom and gloom without clear direction, or at least a minimum of some ideas as to how to actually deal with a situation like oftentimes it's just, oh, the world's going to an end. That's the interview. Let's end it there, or let us whatever, different topic. The point is, again, the current situation is not something most of us have lived through. But again, you always seem to have a game plan. So how do you deal with it? What are you doing right now?
So I'm pretty optimistic about a whole lot of sectors. I recently wrote a piece. I see a massive Asian bull market. I think there's going to be an absolute boom in that side of the world because a lot of the constraints are giving way. Like the entire Asian market's really been held back by its ability. They've all had to essentially run surpluses, get a hold of US dollars to be able to access the commodities and energy they need to grow. Like growth is ultimately usually comes down to accessibility to energy. And what's changed more recently is they can start to trade with each other, and that's when their own currencies and even net settle in gold, which is another bull case for gold, which touched on. But the fact that they can use their own currencies, aren't constrained by the US dollar, means they don't need to run the surpluses that they have, which means kind of like someone having just been forced to save more. They can now use their income to better themselves, and that trade will lead to higher economic growth, in my view, and will really surprise the upside right across Asia. And when you consider Asia already consumes half of the energy in the world, and they're just at the start of their sort of S-curve, which I always sort of reference, like it's when you're in poverty, like Africans will consume a lot more energy, but you've got too big a proportion that are in poverty, and so they don't even have access to electricity, so they can't sort of ramp up their demand when they don't even have access to it. Whereas someone in the likes of like here where I live in Indonesia, they're getting their first fridge, their first aircon, their first motorbike, and that just their energy demands really are ramping up and going parabolic. And so that's when I put that all together, I can't be bearish on this whole side of the world, especially with how much capital has been kind of sucked out of it as well. I'm just seeing crazy valuations across all sort of Asian small caps. Whereas where I am slightly bearish, I guess, would be just the extremes that passive has driven within the West, combined with the extremity of the situation the US finds itself in financially. And that's kind of what I started that piece with as well. Just kind of, I think everyone needs to understand how desperate their position is and how few levers they have to pull now. And that's why I have made a few adjustments to the portfolio with that in mind. I've leaned heavily on physical metals over miners. I'm favouring small microcaps and sort of emerging markets, which haven't really benefited from a dollar of passive flows or anything for a long time. I like kind of label them the sort of bottom crawlers that are just hated, and they're just starting to improve on their business fundamentals alone. And try to hold a little bit of cash, not too much, because I think if you hold too much cash, it sort of can make you quite pessimistic on the world. And I don't see the need to hold cash as well with the amount of opportunities I'm seeing as well. So, yeah, I guess that's a brief overview. I'm happy to dig into any areas you want me to dive into.
I'm happy that Indonesians are beating the EU to getting their first aircon. That's something we still not have figured out. So I'm actually sitting here with a fan. No, it's also interesting, by the way, just how quickly it got dark over there. It's like, what did it take? Like 10 minutes, and it went from like day to night.
I forgot how quickly the sun goes down.
No, but so yeah, a couple of things that I want to talk about. You being bullish on the whole Asian segment. You inevitably have to be bullish on like your main commodities, and like your copper and your oil and maybe your gas, but also because of what's happening in the West, you probably also have to be bullish gold. So am I following kind of a thread here for you?
Yep, no, 100%. I got quite a large percentage of my portfolio now in just straight physical metals. Yeah, and so I haven't directly bought gold all through. I'm starting to, and just sort of a kind of almost a monthly plan of just putting money aside to buy it in a vault, just completely separate from my broker, because I don't like the fact that I'm so heavily exposed to pretty much just IBKR as the vast majority of my wealth. And so I'm trying to diversify a little bit in that way. But yeah, I'm a huge bull on gold to start with. I'm mainly playing that via junior gold miners, as I just find it crazy how hated they are, how the fact they've got very little inflows, generally basket approach there, because I don't think I'm smart enough to pick any winners. I think the average of that will do very well. I see gold remaining bid for the foreseeable future, just because the fact it's largely been driven by central banks and a little bit emerging markets, and there's been almost zero interest from retail participants, which I think will come most likely when inflation rears up. And I see, like in my recent piece, I had sort of a meme, which is the sort of the Brazilian phase, and it's just the idea that a lot of people think, yeah, when inflation rears up, equities will just head you and go up, and that's not how it works. Inflation absolutely massacres high valuations, and once you get depressed valuations, then equities start to act as a hedge. And so I'm kind of trying to get in front of that with things that I think are already sort of joked had a full Brazilian, like they're already trading at single digit multiples, high cash flow, and gold juniors or gold miners in general are just at the top of that list for me. I really don't think you can go wrong. Granted, you're not sort of YOLOing on one junior. It's a really hard space to pick winners, and then from there, I'm a huge PGM bull. I've got a large percentage of my portfolio in physical PGMs and also some of the PGM miners, and so yeah, I'm very long, and I intend to stay very long those sectors for probably years to come.
No ETFs in there though, I assume, and that might also get you to talking about that broader point that you made also in that recent articles, where actually the US now has more ETFs than it's got US companies. So there's more ETFs than stocks out there, which I think that was a very, very interesting finding there. But so what, no gold ETFs for you?
Yeah, no, I do have so hold gold juniors via GDXJ. So I didn't think I could pick gold juniors after going through the space, and even some of the super knowledgeable people that have a great track record just say how hard it is. I know Fred Hickey, he's got an impeccable track record with picking gold producers, and I've seen him say that it's super tough with gold juniors. I think it's easier with PGMs because there's so few to pick from, and I think some of them are a real standout when you look at the actual mine life. Granted, they're in pretty much your choices are in South Africa, which is pretty rough. So I'm currently running like 2/3 of physical and 1/3 is the miners, and I like that ratio as well because it kind of hedges me. If I get taken to the cleaners on my South African miners, I think I'll be looked after pretty well in my physical holdings. And so, yeah, I like that kind of dynamic, that there's a scenario in which I just do well on all of it. And then there's a scenario on I get to taking out a one, and the other section will kind of play its role in hedging it.
So you hold no separate positions in gold, like you're not like no Agnico Eagles or Barrick or Newmont, like any of the majors where you hold separately for a specific reason.
No, I haven't played that. Yeah, I regret it. I researched New Gold, and I sort of, as I was researching, it's one of those things that just started going, and I was like, I'll wait for it to pull back, and it never pulled back. It was like, yeah, a few 100% ago. Yeah, I just watch it every day. It just keeps going up. But yeah, no, never bought it, and never, yeah.
Well, that's actually an interesting point where you watch it go up and then you don't jump in, because you also mentioned that article that you're buying. There's micro caps where anyone who would be a seller has already sold. Essentially, you have those charts that look a bit of like the letter the letter L, I suppose. Sort of a sharp decline and then a flat for a period, right? So everyone who should be selling or who would be selling has already sold, and that happens a lot in the junior market, in bear market specifically. The question always is, though, and in junior mining, the answer is often company related, as you just said. But what you're doing here, how do you know the reversal is about to happen so that you position properly before it happens, as opposed to you want to go up and either chase it or miss it out?
Yeah, so start with that pattern. It doesn't actually work that well when you're a session junior miner. It's like kind of like the bottom crawler, or I refer to it as like a heartbeat. Like you see the patient getting sick and then dying when it's like flat, and then you see the first sign of life when it first ticks up again. That with junior miners is actually because of an awful lot of junior miners look like that. And what you've got to adjust for is share count. So if you're just looking at the stock price, they can often be sort of going down, but the share count's just blowing out. So often when I'm looking at those charts, looking at like businesses that are hated, like going back to seismic as well, but the actual, whether it's market cap or EV, like enterprise value, it's that's gone down and just bottom lined. There's no extra share issuance. Often these companies are reducing debt levels, sales and earnings are moving in the right direction, and so the business is really improving when it's in that flat line. And with juniors, that's often not the case. They're just kind of diluting into oblivion, and so it's a real key distinction. Is that chart doesn't tell you anything in the junior mining space once you adjust for like shares outstanding. Yeah, I forgot the rest of your question.
Well, yeah, you are. And I think this goes back to one of your other recent articles where, again, you're quoting Howard Marks, where being too early is the same as being wrong, essentially, is what the quote is. I didn't write down the exact quote, but that's what it comes down to. And it's that balance that interests me, right? Not being too early, but not being too late either. So how do you know specifically it's not too early? Or maybe how do you know it is too early, but after you've bought? So you buy something and you're like, I expected it to move within 6 months, being a year, it's not moved. Should I be going out or not? How do you, what do you base that decision on?
So this is something I've been really critiquing the last few years. So before, I would often just plow straight into a chart that was bottom crawling and sort of say like I don't need a catalyst. Now I've often try and look behind the scenes, and the ones I love are the ones that have kind of either had a big recap, maybe even had a bankruptcy and a relisting. So they've got their house in order. They've often had a sort of debt for equity swap. So they've cleaned up their debt levels. They might have just had like a massive recap, like issued a ton of shares and now taking care of their debt levels and are in a far better place to move forward. It can be the earnings have been deeply negative, and I love this chart where you see the earnings finally make the first dollar of sort of whether it's net income or any metric where they've been deeply in the red, and they've come back around, generally cyclical businesses, and they're just starting to make their first dollar again. And often with so few active investors like kind of looking at this stuff, no one's really paying any attention till the numbers really start stacking up, and then the sort of momentum chase starts. And the other one is, so I've got one position that's very large now, and that was just physical rhodium, and it was doing this chart pattern crawling on the bottom, and I obviously didn't have to worry about being too early because I'm in a physical commodity. I'm not going to get diluted. I don't have to worry about operational risk. And if anything, I benefit from operational risk because it's 85% of rhodium comes from pretty much one small part of the bushveld in South Africa. And so I kind of loved that trade as well. I always try and, it's in my recent piece as well, I'm just trying to, I was trying to have a hurdle rate, and I'm like, if I can see this position doing well, I've got to comb through the portfolio and really ask myself, why am I in anything else if I don't see an equivalent payoff and also equivalent sort of like downside risk, like if it's the likes of physical rhodium, I saw very little downside risk with that. I thought it was roughly at the cost to produce it, if not below. And saw the mine supply rolling over. So I thought my downside was very limited there. And so once I started comparing that to everything else, kind of colors your view of like, why would I accept this? Why wouldn't I just size up this position? Obviously to a point where my rules with position sizing come in. I won't push past it.
Yeah. And you always do that with physical exchange traded vehicles, I suppose. So like ETFs or something like that. I don't see you stacking physical rhodium under that bookshelf there.
So I literally tried to buy it. Yeah. I went right around the world, reaching out to brokers, discussing how can I put it in a vault. But the problem there is it was such a large bid offer spread on it. So they were trying to make you pay up north of 15%. And so when you're talking like decent figures, the fact that I was going to get taken to the clean is probably 15% on the way in. And I'm guessing they wouldn't be any kinder to me, so maybe 20% on the way out. And quite a few of them even had a clause that you weren't allowed to transfer it out of the vaults. They would be the sole seller at the end. So I disliked that. I was like, that's a recipe for just getting an absolute haircut at the end. So I passed on that. There's pretty much, there's two vehicles you can buy physical rhodium with. One that's accessible on quite a few broader exchanges. It's got a massive bid offer spread. So if you're going to play with that, you've got to just be super patient with limit orders. And there's one in South Africa, and that's the one I really heavily went after. And it looks a liquid, but they actually, it's actually quite liquid. It just has to push above NAV, and then they'll issue shares and buy more rhodium. Yeah.
How many positions do you have right now? Because again, it seems like it's a lot. You know, you're talking about other stuff as well that we could end up talking about. I know you like oil and gas, and the drillers, I believe, is something you've done really well on recently. So how many positions do you typically keep at any one time?
I wouldn't say I've done well on the drillers. That's been my biggest positions have been a round trip to nowhere. So yeah, I'd stop you short there. Yeah, but I've done really well on some of the small plays, but the problem was I weighted them too small. So yeah, but overall positions, I'd say I probably got like 30 or 40. I haven't actually counted how many I have in the portfolio. Got quite a few like sort of 5%ers, and then a whole lot of like 1%ers. Yeah. And the 5%ers, a lot of them are like physical, as I was just talking about, sort of got 5% in physical rhodium. Yeah.
Oh, seismic is what you've done well on. That's what I'm geospace.
Yeah.
Well, yeah. Anyways, that's what I'm thinking about. Not the drillers, actually, that you've done well. You've done really well on. That I've never heard anybody talk about this, and I've absolutely no idea what's going on. Is that something you're still bullish on?
Oh God, yeah. So this is the way I frame it is like, with how pessimistic everyone is on the oil space, you then go to subsectors of oil and say, like, what are people most pessimistic on within the oil space? So they obviously hate the oil space in the first place. And what's like the most punished sector within that space then? And one sector, which I just mentioned that I've had a rough time in, is the oil rigs, which have all largely all went bankrupt by Transocean, and they all relisted at various times, was doing quite well, and it's been a round trip to nowhere on most of them. I still think they've got a great future. But what I'd argue has had an even rougher time than the offshore rigs has been the seismic companies, particularly the sort of marine seismic companies. Leave the space had a 60% attrition rate. So from the peak in 2012, 13, over 60% of the companies went bankrupt, were taken over, were merged, or just closed. And so when you comb through, there's very few left. And even some of the bigger players like Schlumberger, they largely got rid of a lot of their, like a lot of it's actually in private hands, like there's some of the companies. So there's very few to sort through. And the companies that have survived are actually surprisingly quality. Like you just mentioned, Geospace, it's actually a really good company. It's just been capital starved. It's no one's wanted to give it a contract because the whole IEA, we're not going to need oil in a few years, and that whole narrative has everyone sort of believing that these companies are extinct, essentially. And I really want to take the other side of that, and I've been taking the other side of that. Most of my recent positions have actually been in that. I've bought my last piece before the piece I just wrote was largely buying more seismic companies, and buying call options on seismic companies as well, long dated.
That's where, and it's essentially what you're saying here as well. It's like, and I'm quoting, it's where I feel most comfortable in this market, filling the portfolio with these startups, unquote. But you're up 300%. That's almost on geospace technologies. So that's a 4x.
I'm not up that much because that's just on a 3-year time frame. I bought it a bit after that. Yeah, okay. I just ran all the charts on 3-year time frame because otherwise, if I tried to run them exactly when I bought it, it would have been an absolute mess. But yeah.
Well, but so you're up, and these stocks are up, generally up. They're up. Well, I mean, the other two that you compare it with, one of it is actually not up, but the other one is still up like 35.5%. And so my question is, how do you deal with that? Like, how do you have this bullish narrative, but it's already up so much. How do you know to still keep deploying capital into it? Or how do you build the confidence to keep deploying capital into something that's already ran?
So I don't keep deploying capital into it. I size the likes of Geospace. I've got a 5-year time frame on that. I've allocated 1% to it, and it's now whatever it is, up to 200 something percent. I'm just going to let that run. Some of my problems have been like, when do I actually start trimming these? Because I've had cases where I've just let stuff get silly, and I kind of regret it with miners particularly. These companies will be harder because these are actually good companies, and I could literally hold some of these for a long time. The other one there, that's doing well. I honestly think they'll probably get taken over though, which is a sad thing. I doubt I'll get sort of a 10 bagger out of that because it'll get taken over well before that. And the other one I've only just bought, but that's the largest in the space, and that's just made a whole lot of dumb decisions with wind, and it's got its ass handed to it. And I think that business really turns around, and they're quality businesses. They're if anyone's ever looked at seismic companies, there's a lot of technology. I've often joked, I think like the AI bros will come for them when the other stuff stops working. Like it's stuff that AI would really assist. And once the spotlight comes on the fact that oil demand is going to hold up for the foreseeable future, and as a result, going to need to be more exploration. We're not going to be running the world on wind and solar, or everyone driving EVs. And that's another part I haven't really mentioned. There's a lot of my portfolio is largely taking the other side of kind of net zero in some fashion, whether it's the PGMs, which is the idea that the world will completely run on EVs and we won't need catalytic converters for internal combustion engines, or just mentioning seismic, which is saying that there won't be a need for future oil exploration offshore, whereas I think that's where the majority of future oil is going to come from.
So what is it that you're looking for in these companies? Is there like a one-stop metric where you're looking for, I don't know, FCF growth or P to book value, or some of the most traditional valuation metrics, or what are you looking for in these companies?
A little bit of everything. Looking for them to have manageable debt's the first one. I don't want a lot of large debt maturities that I don't think they can handle. Some of them got decent, like Geospace got a decent amount of cash. Last time I looked, I think it's like 20, 30 million, no debt. So they give them a long runway, because the worst thing in these is they're not going to get contracts. It could be a long period between getting contracts, so you don't, can be quite lumpy, the earnings, so you don't want them to be levered. And generally the ones that were levered have already gone bust anyway, if I'm honest. And then you have others which are more special situations, like that one. And there is, that's recently kind of, they had a, what do you call it, like A shares and B shares, and that's been conjoined. And so it actually makes it a lot cleaner. And previously the company had to pay dividends to the A shares, and it kind of sucked all the cash flow, and it was just a messy situation. Now that's been cleaned up. I think that company can really re-rate now. And yeah, earnings look good. It's not got no leverage, and just gradually signing contracts. So just incremental improvement, really. Yeah.
What are you looking for then in terms of a sell signal here? Is it something where you, like, owners start to add vessels or something, or activate cold stacks? Or I'm way out of my depth here, so I'm just kind of trying to name words that I've heard before. But yeah, what is it that you're looking for to end that bull cycle?
Yeah, that's where you got to hit for the exit with any vessel based, is like just keep an eye on the order book, and historically knowing once your order book starts rising, your time's limited before there's going to be more supply. These likes of rigs and tankers and OSVs and everything, they're terrible businesses overall, because inherently they overorder. There's creates a glut. There's just a massive sort of a, what we call a consolidation phase, where a whole lot of them go bust and go bankrupt. That gets overdone. Everyone hates the industry. There's so few left. Order book gets too low. Booms again. They make crazy money, overorder, and then round and round you go. I've actually got a chart of, I believe it's tankers, and it goes right back to like the 1800s, and there's just boom, bust, boom, bust, boom, bust. Even some of the seismic companies that have survived, it's just boom, bust, boom, bust. It's they've had multiple boom and bust since the 80s, yeah. And so it's just understanding that cyclicality, and coming back to the Howard Marks quote, not being too early as well, because as I said, a lot of these, you didn't want to be early to the likes of offshore drillers. You had a horrible time. Granted, I admittedly had some completely go bust on me. Originally had a position in Valaris that went to zero, and also had a position in Saipem that pretty much went to zero because of the just sheer amount of dilution. But the thing with that is, kind of had to stomach it and buy it again when it relisted. And with Saipem, stumped up more capital and went again after the recap. And that position's done really well. And yeah, so sometimes you just accept you're wrong and have to go again.
I'm looking at something that seems to be more bust than boom, and that's nickel. Just trying to see year on year, it's not done too well. It's not the worst performing commodity, but it's something that seems to be completely forgotten. And it seems like it always is completely forgotten, besides those brief periods when it's not, and then everyone's always talking about it. So is there anything you like in the nickel space? Again, Indonesia owns the field, so that makes it more challenging, but not too dissimilar to PGMs in South Africa. So yeah, what are you looking at into nickel, seeing anything there?
Yes, I've looked through nickel. I can't get excited about it because it was too recent that it was part of the whole sort of transition metals theme, and there was quite a bit of money, and still is a reasonable amount of money has been poured in. Well, obviously not recently, it's all really died down. There was a decent amount of money put into it. So whenever I see a theme like that, I'm like, if there's any price action, there will be a whole lot of sort of marginal projects that'll jump on it again. When I get excited about a commodity, I want it to be like the supply side, like properly dead and buried. And even then it can take a surprisingly long time. Like uranium's like a perfect example of how many times have we heard the supply deficits going to cause sort of a massive gap, and utilities are going to have to come in and panic. And like here we are, like years and years into the thesis, and the utilities haven't kind of shown up there. The the supply shortfall hasn't actually forced them to the table just yet. And so I always think of that when I'm looking at some of these areas, like how recently was capital being poured into this. And there's often a very large lag. I think like lithium is going to show this for years to come. It's just how much money got thrown into the exploration and sort of development side of that'll forever kind of not forever is a long word, but it'll pressure prices in that for years to come. And I'm a bit iffy on, I think a lot of the projections were wildly optimistic for how much lithium would be required for sort of grid batteries and EVs. So yeah, all things equal, I want something that there's a sort of a belief it's not needed. I saw that with PGMs, like sort of there were comments of it's in terminal decline because it just won't be needed for catalytic converters. So like, why would you need to invest in it for the future? I love when I see that. It's similar to what we've been talking about, seismic. Why would you even consider these companies when there's no need to search for more in the future?
With nickel, it's interesting, the narrative moving away from NMC batteries and toward LFP batteries, right? So saying that we're not going to need it, but that's not everything nickel's used for, of course. So does that not fit that framework? Yeah.
Yeah, it's not a great framework. Obviously, it's a very small percentage, but it's enough that I've got limited capital and limited themes, and I just think the story, like the PGM story, is a lot tighter, a lot more compelling, and I can wrap my head around a lot more. And I think nickel's down the list. Would be the way I'd state it, I guess. Yeah.
With lithium too, it's kind of hard for me because of the supply side of it. Like it seems like the guys in South America, they produce it at, I don't know, a negative cash cost or something. And I'm joking, of course, but they just produce it very, very cheaply, right? And every time there's a little bit of a bump, they turn on supply really quickly as well, because it just works. It just works differently as well. And again, I don't know the nickel market enough to be able to make conclusions like that for like in general, but just for myself, it's much harder to understand than something like copper, but definitely something like uranium, where the supply deficits have been apparent for a long time. So yeah, lithium. Anything else you want to add on lithium there?
Well, it's just it's okay to say, like, I just like with me, I find it too hard to understand. I can't get as bullish. Like I think the simpler the thesis is, the better. And with PGMs, I thought I could really wrap my head around that. Like once I understood it was the whole supply side for particularly platinum and rhodium was just in South Africa. And then I could start reading literally 3 companies' reports. You just got Valterra, Sibanye and Impala is the vast majority of it. Read them and understand what they're saying, where their break-evens are, where they're losing money, what they're shutting in. It's not that hard to understand, nor nickel. It's like produced as largely as a byproduct. It's palladium heavy, so that even if they bring on more, they're not bringing on much platinum and rhodium, so it doesn't actually impact. And even then, they were pushing back their projects. And that's 4 companies that I just need to sit down for a few days and go through all their filings and reports and read that. And then the next step is finding the smartest people in the sector that have got the best information. You actually had an interview with Dr. David Davis. I think you might have got someone else to interview for you, but he was like the expert on the area, on PGMs, particularly in South Africa. And he just did amazing work on it. Unfortunately, passed away last year. And so otherwise I would have loved to interview him. But he was the absolute sector expert. And there's usually very few of them left. Like he was obviously at the end of the career. It's what he'd done his whole career. And so he stuck with it. But I'm seeing that in a lot of areas where the guys that have got all the experience are either retiring or dying off. And so like you having that, like with uranium, it's a good example. Like I kind of worry when I sort of see John Borstoff, he's a guy that can actually deliver a mine. Like I don't know how much longer he's going to last. And so you've got that as well, that I put it to tie this to my piece I just wrote. I've actually got a chart in there where I'm talking about how everyone's been pouring into the sort of flashy jobs of tech, of white collar service work, which has been where everyone wants to be. And I think the entry level gets absolutely massacred by AI. And I had a chart or a survey below it which was like, what industries do you want to work in? And asking like young workers, and it was like, absolutely not. And it was like mining, oil, like anything kind of sort of dirty, or and everyone wants to be in tech, and everyone wants to be in finance and healthcare. And I just find that's like cyclicality in a T. Everyone's training for the safest job of the last decade, not what will be the highest paying job for the next decade.
And can you blame them? I mean, some of these guys are getting, sign-on bonuses that are multi-million-dollar. There's this one, outlier story, but the guy who got $100 million as a sign-on bonus to work in AI, right? And so natural to go and chase that and not go and chase, nobody wants to be a coal miner, I suppose. So that's what it comes down. And that's actually, it goes back to what you just said about an easy thesis. I mean, you just look where people don't want to be, and that's really pointing you in the right direction, probably. What do you think is the easiest thesis right now? Is it PGMs? Like, is that just the easiest thesis right now that you have?
Yeah, I'd say it is. I'd say it's the I've got one chart that I love. I didn't actually put it in any presentations yet, but it's just running platinum by the money supply, and it's just, the thing hasn't even moved. And then when you kind of frame it in that way, like I started the piece with, I think literally we're in a position where they're going to have to print the difference, the Fed, that's whether it's employment rising, whether it's inflation kicking off, whether it's AI spending coming back to earth. We're going to go for a phase of higher inflation to get the debt down, inflated away essentially, because there's no willingness to cut entitlements, defense, everything that would actually move the needle. There's no willingness to do it. And you just want to be in a hard asset. And I think the fact you can position in something that is already so hated as like platinum was, like essentially went nowhere for like a full decade. It just crawled along. Like anyone that's invested in it has had the most frustrating time. And my experience is when it breaks out, it just plays catch up. Obviously touched on the South African side. That's primary supply is like dropping 5-6% year on year. And I think with my Asian bull thesis, I think the industrial is going to really surprise the upside. I think catalytic converters will continue to surprise the upside on the back of hybrids being the main vehicles that will be adopted. I think this, like the BYD, what they've done with some of their recent vehicles, they can get like over 2,000 Ks on a single tank of gas and a charge. And you can buy these vehicles for just over like low teens and found like sort of 14,000 US. It's just absurd. Like the value proposition, nothing else comes close. I've actually got a chart which really fascinates me, in that it's the only chart I've ever seen at which it cuts vehicles sold in all the major, and it doesn't do the sort of EVs versus normal vehicles. It just does catalyzed vehicles versus non-catalyzed vehicles. So it's full battery electric or catalyzed. And 97% of vehicles sold in the emerging world have all been catalyzed. And so that's, for me, platinum and rhodium will continue to surprise the upside. Well, supply will continue, and that's before getting to the obviously with platinum, you've got the jewelry demand, and you've also got the investment demand. You've got people can, and the likes of China has really shown that they're willing to really ramp up the investment side. When gold gets too expensive, there's a substitution with white gold as well, and that's what's been driving the price more recently, has largely been jewelry and investment. And to finish off on it, the above ground inventory is now below 3 months, and I think that even overstates how bad the scenario is, because the majority of that's held with China, and they don't trade raw platinum of the world. They keep it for their domestic producers to add value. And so the likes of Europe and Japan, they're largely hand to mouth with the miners, and the South African miners, which have got all sorts of issues historically. And so, yeah, I think the risk reward there is very skewed to the upside over the long term.
I think your dog either agrees with you there, or he's just tired of listening to my voice. I miss seeing him, by the way. He used to be by the window when we did interviews. Now he's not. And I can see why, or I can hear why.
Super fat. nearly 20. He's nearly 20 kgs now. Yeah, he's in his old age. He just eats.
That's a big boy. On the topic though of simple theses, I just dug up a tweet of mine where I think I felt smarter than I really am, because I wrote uranium supply equals fragile and shrinking, uranium demand equals inelastic and expanding. It's not that hard, folks. Even I get it. That's the whole tweet. And it's like, that still feels like it's a thesis, but this tweet is from November 27, 2024, looking at the price, basically the exact same price as it was today. But from there, the price just kept declining down from, it was about 77, 78, down to like 63. It seems to be back up, coming back up again. WNA just finished, I suppose. But again, frustrating. Even though it's simple, it's been a frustrating trade overall, I think. What are you doing with uranium? Is it getting you frustrated as well? In the meantime, have you trimmed, or are you adding any positions? What's going on there?
Yeah, so I'd say it has been extremely frustrating. Even though I've done very well, it was just, I think expectations got ahead of themselves, in that I honestly thought utilities would have come to the table and would have contracted far past replacement rate. I thought we would be at a period now where they would have driven term significantly higher and would be contracting sort of 110, 120, like well over the 190 odd million pounds of replacement rate. I would have thought it would have been well north, and that just hasn't happened. They just, if anything, like the most recent, I saw an RFP from a sort of Korean utility that was just throwing out 65 floor and 100 ceiling with no escalation. And I'm just like, it's a broken market. And so, well, I've done very well out of uranium. Essentially got lucky with some purchases in the sort of COVID era and rode them up, and some down a bit much, but overall did very well. And I've kind of adjusted how I'm positioning now, because I see, to survive, a lot of the sort of producers have over-contracted. And I think there's going to be a different regime. It's going to be a real step up, and a lot of these producers that have filled their books with suboptimal contracts are going to get quite hurt by it, because at the same time they're kind of having costs blow out. Like even the old bear case, which was Kazatomprom will just flood the market. Like I was looking at their latest asset all-in sustaining cost, and it was up, like the 2025 guidance was up 220% from 2020. And they were supposedly the ones that were going to flood everyone with low-cost uranium. And then obviously had even Cameco dial back. What was it? Just lost 3-4 million pounds. And then you can just go through the absolute disaster that is the entire sort of all the producers, and even the names that have done well, like some of the US names, like largely it's kind of strategic value. Like the likes of UEC, I think is pretty wildly overvalued, honestly. Like he's just a great marketer, and he's obviously positioned himself very well. But I'd say the risk reward there is terrible. I always had an axe crying with that anyway. I just disliked, as soon as I read through that company and sort of paying himself. He's got a separate company that he pays himself and a few of the other management, and never particularly liked it. So where I've come to with it is I want a heavy physical position, and kind of quite like the appeal of, we've only recently now, I think in the last week, you can now get exposure to call options on the actual physical, which is quite a clean play. So that's only just become available. Granted that I'd prefer if you could actually get leaps on it, would be great, but they're quite short. They're only out to June 26. And I'm kind of leaning more into sort of greenfield projects that are kind of trying to hold off final investment decision. Ideally, got haven't sold any sales agreements. So when they do start signing contracts, I think we'll be in a new sort of structure. We'll have far higher floors. Like I've thrown out that floors I see being sort of 120 and ceilings like 180, 200. Like I see just a real step up, because nothing's really come on. Like there's just a massive, like the tweet you started with, it's still a massive supply demand imbalance, and what we've seen out of all the prospective producers is largely just face plant after face plant. You've got like some Peninsula, which actually had to do a raise to get the money to get itself out of this offtake agreements that it signed. Yep. So there's those, like, you can even question what they're actually going to produce in the coming years. And you got Boss, which is obviously scared the pants off the market with it sort of saying they're not sure where they sit post 2027 with the guidance. And then you got Encore, which is massively overcontracted and had lots of cost blowouts. So I don't really understand how they produce much cash flow. You just go around the whole sector and there's not many. And the ones that are supposedly going to bring on the big pounds, like, got to kind of question on current form of all the, particularly all the ISR. Like, it's kind of, after you've seen Peninsula, Boss, Encore, like, look out to something like Denison and you say, like, is it they're trying a new method? Is it kind of is it smart to think they'll just execute perfectly? Yeah. And so, yeah, I've really adjusted my strategy with that. I don't really want any miners. I don't really want large contract books. I prefer quality greenfield and a large physical position.
Yeah. It seems like a lot of a lot of these things have turned out to be true, and kind of through over engineering of portfolios, a lot of money has been lost in the meantime as well, I think. And it comes down to the physical, just because the market is such a mess within uranium, which actually exacerbates the whole bull thesis, because of how much of a mess the whole chain, like from exploration through to development and production, it's based, almost every company is a big mess in uranium, which makes the thesis more exciting to the upside in terms of the metal price, but it makes it harder to get exposure to it, besides, I guess, the physical. What about if Sprott and or financials just in general, not only Sprott, but what if they pull the demand forward again? What's your kind of don't get queued exit rule on uranium? When are you going to throw in the towel, or when are you going to scale out completely?
Yeah, so that's the way I come at it now, just a sort of a relative value. I've got a whole post on like what I would see to start scaling out uranium, and it was being too cute in hindsight with the vehicles in place. Like I was sort of saying, like, I'd take X amount off when it gets to 120, and then I'd take. I still use it as a game plan if we get a real run in uranium. But I think generally when you exit something, it's just because you've had a good run and you see something that's far more attractive, which has got a better risk reward with lower downside. Like, if you're lucky enough to have had something that's gone up 5-10x, and you see something that can be an easy double that's bottom crawling, it's silly not to move that capital along. And that's I've paid the price for sort of riding something too far when it was I was well aware of superior risk rewards, and I was kind of glued to the thesis of I'm going to ride this exactly till the utilities show up and I see exactly these metrics before I start trimming, and that damage returns. Left a lot of money on the table by doing that. And so, yeah, I'd lean more on the sort of relative value, and especially if it can be stuff that has an inherently kind of lower downside than like miners. Like, just you kind of hit the nail on the head in the fact that, like, the thesis has got stronger, but the applications for the thesis and all these miners has got a lot worse. Like, a lot of these guys that have really contracted heavily have just damaged themselves, especially when they're like fixed contracts. And it's just, and they're just having so many struggles with the production process itself. And so, yeah, it is super tough. And the way I'd exit it would be, gradually, and probably try and be putting into something I see that's just got a bottom crawler, something that is off everyone's radar and is just a hop and a jump from sort of a double, kind of what I've been seeing at the moment with some small caps in the Asian market. It's just no one really cares. Like, sort of, I bought one recently. There was a pipe producer that's been doing really well. That was like 50 million. And yeah, it's had just a chairman that he owns 70% of the company. He's owned it for decades, and paid down most of their debt, and they've been doing good things lately, and no one cares about it. No one even sees it like it's something off 90% of people's radar. And I just want to keep finding stuff like that.
What's the most complicated thesis, though, in that case? I mean, basically everything you've told me here seems relatively straightforward, and because again, even I can get most of the things that you're talking about here. But what's the most complicated thesis that you're exposed to right now?
That's a good question. It's complicated. I try and keep stuff simple. If it's complicated, I'm probably fooling myself. I'm probably going to lose money. What's something complicated in the portfolio?
What's the thing that has the most variables in it where you need like, oh, if that goes well and that goes well and that goes well, then I do well. Yeah.
Well, what I've been tracking, it's not my trade at all, and it's is Sable Offshore, and it's just like event driven, and it's one that I'm glad I didn't get involved in, like talking about, because it's so complicated. There's so many legal back and forwards, and this has been tabled, and this has been like that is so far outside my circle of competence that boggles my mind. One I'm trying to get up to speed on now that I want to write a piece about in the future is Canadian oil producers, and how there's no one explains in pure English the difference between like the sort of producing reserves potential and there's all the different levels of what they find and how they're graded, and how you can buy really cheap producing reserves. And I've never come across a piece that explained that, and so I'm trying to learn this all with AI. I've got a friend he's explained it to me, and I love kind of wrapping my head around it. Then once I fully can understand it, then I can try and explain it in a simple way. I think a sign of really understanding something is I can kind of try and explain it to my toddler son. Like it's that whole Feynman, you don't really understand it unless you can teach it to like a 5-year-old.
That's an interesting way to put that, and maybe you should explain it to me in that way as well. Maybe write it down, and then when you come to talk to me on a podcast, explain it to me that way as well. I want to work toward wrapping it up here. I don't want to keep you up all night, but if you had to manage capital for other people, let's say, and people who don't really or maybe understand it as well as you said your toddler does, but like they don't want volatility, but they want the returns that you generate. What do you put that in? Like, what commodity theme would that be, or commodity equities? What do you think would survive kind of your own critique today, or just survive the market today?
That's pretty much what I'm doing. I guess I'd be heavy physical, platinum, rhodium, uranium. Those are a big chunk of my portfolio, just not trying to be too smart. If we get a big smash in the market, I'll try and leverage them in some way. Like if we get a real liberation day too, I'll probably try and load up on some uranium, some spot physical uranium options. And what I love about them as well is it's not a speculation as much as if I buy them at the money, I intend to often exercise that position. Like I've got quite a few calls in a company called Saipem in Europe, and I bought those with the full intention of like exercising them, and when they expire in December 2027. And so that company's paying a really high single-digit dividend. I'd like to own that company for years to come, and the fact I can get in there with a cheap option without having to outlay much capital at the start, and then when I eventually exercise it, I won't have to come up with much capital. I love those trades, and that's also why I try and keep 5% of the portfolio in cash, because I've got a few of these that I kind of have in mind. If we see some real disorderly trading, I'll put in what I call like stink bids. Like I'll put in like bids that I'll dance around the room if I get hit. Like it always struck me when I first met Brad, and I was talking to him about, I was trying a bit of Forex trading at the time, and he was just like, just stop losses are just foolish, because people will always hunt out where you are in the market with like a stop loss. Like you'll get that long tail down that'll just fill itself. It'll be the low of the night, and that's where you'll get taken out of the position. And he said, the way to conceptualize that is that's like short volatility. You want to be on the other side of that. You want to be that bugger that's got the limit order that's just way out of the money, and that last person that panics hits your bid before the thing rips back, and you end up a lot in no time. And so I've always kind of taken that on board, that I love to, some of it's just as well feeling, as Brad say, if you're having fun, you'll stay at the table a lot. And like, I love, even if there's a massive crash and I've only got a few percent to work with, if I feel like I can get a win, it's really good for your sort of mental state through that as well. Like, there's nothing worse than being fully invested and you have an absolute meltdown, and you just got to watch your portfolio go lower every day. Like, it's quite important to even have a little bit to deploy. Yeah, it's funny, the sort of way the mind works. So similar to selling, like if you, I always say to kind of avoid binary decisions, like just trim stuff gradually to get out, because otherwise if you sell all at once, then there are occasions where you should sell all at once, obviously, if something really changes with the thesis. But if it's just because of it's run too much, then keep trimming, and then you'd be surprised how much it sort of it eases the burden of seeing it going higher. If you still own like maybe 10% of your position, you can just ride it to like silly levels. That's how I've often framed that as well. Is like never make binary decisions with selling unless there's a real reason for it.
Well, it's funny you mentioned that, because it's I'd never actually played blackjack before this summer. I went to the Yukon on a couple of site visits. There's like this sort of charity casino where the proceeds go to the community or something like that. And so we went there kind of for the laughs. I put in some money into the slots, obviously lost it. The guy next to me, the guy that I was with, he put in $5 and got in like 130 out of it, like on the first pull. And I lost like 20 or whatever that put in it. And it got me pissed off, but he's like, let's sit on the blackjack table. And so I sit down, start playing, and like beginner's luck, I got 2 blackjacks back to back, and then a third one later on. I'm like, this is great. I want to stay here. But eventually I realized that I tripled my money from going in. I think I went like with $40 into the casino, and lost 20, and the 20 that I'd left, I then tripled on the blackjack table. So up 50%, had fun for the night, but you got to leave like at a certain point. Even though it was a lot of fun. Like the first time there was a bunch of people there, and it was just a lot of fun, but you have to leave eventually. And I've been thinking about that. Maybe maybe it's not too deep or anything. It's just, had luck in the casino essentially, but it is, blackjack is close to investing, I think, and so is poker. And I've been thinking about that ever since. But you do have to leave eventually.
Yeah, well, I love that observation as well, because it's often doing the right thing is often the hardest thing to do at the time. So selling well is often when the story is the best, it's the biggest up day, and you're the most excited about the prospects. Whereas buying is often when the story feels the most hopeless. You kind of feel sick when you look at the stock. It's just we're wired wrong to make money in the markets. We're like behavioral animals. And like I said, some of my best purchases ever were simply, I put the limit orders in when I was in a rational state before the market opened. And then I nearly threw up when I saw they got filled and where the market traded. And I wanted to jump in my account and sell it again and thought it was going to zero. So it's, I'd never overestimate your ability to how you think you'll act rationally at the time. Like I always loved there's an example of Stanley Druckenmiller, and he's like literally the most impeccable track record ever. He's never had a down year in like 30 years. He knocks like Buffett and everyone else's track records out of the water. And he had a period in the dot-com boom where he just couldn't handle watching a few young guys just absolutely making tons of money. And he jumped in literally at the top of the market with a few billion and lost it. And when he got asked about it, he's like, I knew I shouldn't do it. I shouldn't have done it. I was just an emotional baskets case. Like I learned nothing from that whole experience. Just my emotions got the better of me. Like if the most cold, calculated guy can make that mistake, don't any of us think we're above it? Yeah.
Just, well, I think when was it, last week? I think I talked to Ian Castle about exactly that. He wrote about it in one
He's
of his
great.
recent posts, and so I talked to him about exactly that situation with Stanley there and with the drug. So yeah, there's a lot that we can talk about here. What do you think we're not talking about? Though we talked about a lot of commodities, um, gold, PGM, oil, the drillers, seismic. Even I took a whole bunch of notes. What are we not talking about though? What did you come here hoping to talk about that I failed to bring up?
Um, I've been recently thinking more and more about like because I've had this scenario where I've got a decent amount of money in this like thing that was like the South African rhodium ETF that was really hard to get access to. And it's funny whenever I flick my I've got like the user stock app on a MacBook, and you can flick to the side and you see all your positions. And rhodium's in the middle of it, and it's often rhodium just goes to a completely different beat to the entire market. Like everything else will be deeply red, and it's bright green. It's like up 5% when everything's down 3%, and then it's the other way around. And I've often thought about like I certainly want to take my trading to go places where just other people aren't finding like it's just a little bit too hard. And so an example is I've been like kind of looking around Asia because my whole Asian bull thesis, I'm like, IB doesn't allow you to go into Indonesia, Vietnam, Thailand, doesn't allow you to access a few classes of Chinese shares. Philippines. I wrote a piece a while ago on emerging financials, and I identified a few small Philippine banks, and they've been shooting the lights out, and I did nothing about it because couldn't access it. And I'm thinking like rectifying that, and I've just seen some crazy value. And obviously, it's they haven't been a great place to be because the place to be has been US and in front of passive flows. Like it's just you've absolutely crushed it in that. So no one's even looking at all this stuff. So it hasn't received any capital. It's been capital starved. If any of these stocks are starting to go up, it's purely on their fundamentals. And I want to be there. I'm looking at one little Thailand company at the moment that's it's only like 60 million, and it's over 60% of the market cap's in cash, and it's trading 2 times EV to EBITDA, pays like nearly a 10% dividend. It's just like, and it's just bottom crawling. Yeah, I'm just like, give me that sort of stuff every day over even some stuff kind of gets a bit like tribal as well. Like I feel like sometimes uranium gets a bit tribal. Like whenever I talk about it, like people, I can't believe you're like thrown in the towel on that. When people are that wound up about it, they're not thinking logically. Like my ideal scenario is when I mention something and someone's like, why would you want to own that? That's like the worst thing I've ever heard. Like that's like sounds like an absolute waste of time. Like seismic, tell me when oil actually starts to work, and I'll look at seismic, and that's like kind of where I want to be. I want to be like almost past peak pessimism, is like just complete indifference. Like, oh, why would you even look there? That's gonna be such a waste of capital.
Well, it'll be good to catch up on these segments of the sector and different sectors in a couple of months' time. I'll keep reading the Substack. In the meantime, for people listening, it's Trader Ferg on Substack. I actually read it in my email, so let me just click through it so I can see the exact link. It's traderferg.substack.com is where you do your writing these days. You're not on Twitter much these days.
No. Unfortunately, Twitter's taking a turn for the worst. Yeah, got a lot to thank Twitter for back in the COVID days. That was like literally the first social media platform I ever jumped on, and really enjoyed it then. But it's been taken over by the bots and the For You tab, and it's just not a fun place to be anymore. Other than judging market sentiment, I still like typing in tickers and see what everyone's ranting on and judge. There's a few smart people that put out good work on it, but on the whole, I don't really go on it nearly as often as I used to.
Well, you have a free option on Substack, I believe, and then the pro version where you write about these articles that we've been talking about. So again, it's substack.com/@traderferg or traderferg.substack.com for people listening. Ferg, thank you so much for sitting down with me today.
Thank you so much for having me. I love these. Look forward to coming on again.